Hello everyone. In this session, I'm going to talk about the various rating assignment methodologies. Right? The credit rating agencies want to give a credit rating to the various banks and to the various institutions. Now, if they have to give the credit rating, there are different ways of assigning that credit rating, different kinds of assessments that the rating agencies can typically do. So this is a slightly a bigger chapter wherein initially we'll try to understand what are the key features of a good rating system. Then what are the various approaches that are there to predict default of a particular counterparty. Then talk about rating migration matrix. So change in the credit ratings. What is the probability that within a year a company's credit rating will change from a triple A to a A? Such kind of transitions. So that is what we are calling as a rating migration matrix. And various terminologies that are involved with respect to this rating migration. We'll try to see with example how do you really compute the default frequencies. Then what is the methodology that is typically followed by the rating agencies for both the issue related ratings, the bonds or any other CDOs or some kind of instrument that are issued by the financial institution? How are those issues rated and how is the issuer rated? The company which has issued these financial securities. So, what are the various methodologies that are adopted by the rating agencies to rate both the issue as well as the issuer? Then we are also talking about the kind of relationship that is existing between the rating that is associated with a borrower. So, let's say a specific borrower is having a A rating or a AAA rating. How can I link it to the probability of default? So that's one more important point that we are looking at. Then we are trying to compare those kind of rating systems which are purely based on experts. Internal experts are saying this company can be given a loan versus this company cannot be given a loan based on their experience and expertise, versus the rating agency's methodology using a rating transition matrix, etc. So if I have to compare these two methodologies, I will compare based on the various features of a good rating system and say in which case which method is better compared to the other. So once this aspect is done, we will move to a few quantitative kind of approaches, right? Statistical based approaches for estimating the probability of default. Within that, we have two broad headings. One is the structural approach, the other one is the reduced form approach. So we will have different techniques under each of the approach. For example, the Merton model is a part of a structural approach, whereas the linear discriminant analysis and logistic regression models, they are examples of reduced form model. So we'll try to understand what are the structural models and what are the reduced form models for estimating the default probability. And we have a few non-parametric kind of models also that are coming into picture, or probably let me not call it as non-parametric. We have unsupervised kind of learning methods. The analytics world calls them as unsupervised learning, where we would be covering cluster analysis as well as principal component analysis. How are they really influencing the computation of the probability of default, or typically they play a role in terms of grouping the groups of customers or institutions, or they could also do grouping of variables. So we will look at how they are playing a role in terms of understanding the default of counterparties. Then we'll talk about simulation modeling, cash flow based simulation. How will it play a role in terms of assigning the ratings and default probability? Then, so now that we get a good idea of different kinds of statistical and quantitative methods, we will look at which one is better, again by comparing, by trying to understand the various features of the good rating system, and then compare all the models that we have discussed, the numerical and the quantitative model. Then the third dimension is coming. So one dimension is using the rating agencies approach, which is a rating migration matrix versus expert based approach. The second is all quantitative and statistics based approaches, whereas the third one is actually based on artificial intelligence or heuristics. The same thing I can do using artificial intelligence or heuristics. So again, I'm trying to compare various heuristic approaches and the numerical approaches. We talk about something called neural networks, etc. out here. So that's one more way in terms of assessing the probability of default. And finally, I would also look at not all these quantitative methods or statistical methods. Sometimes some kind of qualitative information is also necessary in terms of assessing the probability of default. So when I'm trying to decide or design a credit analysis questionnaire, what are the kinds of various qualitative terms I have to include, and how can I get the qualitative information? What is the kind of qualitative information I have to collect, etc. All these things come as a part of this session. So a very lengthy session. I suggest that you give more and more importance to it, as so many useful techniques would be covered as a part of this session. So let's get started. First of all, if I have to understand the key features of a good rating system, the first feature is it should be measurable. It should be clear, no ambiguity in measurement, as well as verifiable. I can test that back by doing a manual calculation. So whether I am computing the default probability, the computation that is coming out should be absolutely correct, and there should be a way that I can verify it. So back testing should be continuously performed to ensure that whatever the computation that is done by the model is absolutely correct. Then a rating system should be as objective as possible. So there should not be any kind of a subjectivity. The judgment relating to the credit worthiness, it should be purely based on credit risk considerations. It should not be influenced by any other biases. Right? Everything, whatever the rating that is being given, I should be able to link that rating to the credit risk possibilities of that particular institution. So if I'm not able to link it or explain it, then again that rating system is not of a good quality system. Similarly, we talk about homogeneous, right? I should be able to compare. Let's say I'm talking about portfolios. It should compare which one is more riskier compared to the other. So it should be able to compare different market segments, the debt segment versus the equity segment, or junk bonds versus risk-free bonds. So, or probably normal corporate bonds versus high-yield bonds. There should be some level in which the discrimination should be there, comparison should be there. So the mechanism that is used should be homogeneous across. Then there should be a kind of a specificity. So we are talking about the distance from default. It should not link it with various other corporate financial features. So if we are talking about a stock prices fluctuation, that may or may not be that may not have any kind of a relationship to the distance from default, right? Because the distance from default is, or the default of a company is possible when it is not able to meet its debt properly. So its operations are not good enough. It's not able to generate profit from its regular business, and because of that, the profitability is getting questioned. So not that because the stock prices are falling, the firm is going more and more into a default. Even if the firm is going into a default, both the chances of risk are going higher, and even the stock prices will fall. But one is not a determinant of the other. So it has to be very clear while giving the rating. It can't take everything based on the fluctuation in the stock prices and directly give ratings, credit ratings based on the fluctuations of the stock prices, especially the short-term fluctuation, right? So these are the four major dimensions: measurability and verifiability. A good rating system should give an objective rating, comparable, homogeneity should be there, and there should be enough of specificity. Now, moving on to the next part, where I want to identify the various approaches to predict default. So on one side we talk about an expert based approach. We have experts. So we are talking about people who are more and more experienced, who know the various, how do you really give weights to the intuitions and perceptions. So they have a very strong knowledge of the entire credit process. So he is a specialist, and based on the experience and the expertise they carry, they are giving the assessment of the various firms. That's an expert based approach. We also have various other traditional approaches where we talk about a Wilcox model, and in that, the Wilcox model, the probability of default is simply treated as what is the probability of loss divided by the probability of gains. So what is the chance that the company will make losses in the next 1 year versus the probability that it will make gains in the next 1 year, and then we are raising it to the power of the initial endowment value divided by the profit for each round of the business case. So basically this is telling me approximately the number of periods in which this profit as a proportion of the total loan that has been taken. So for how much years it will typically take for the profit to match the total loan amount that has been taken. So it is working out, if you look at the power, it is nothing but 1 by return on equity, because the profit is, so if you are talking about the profit and this is the kind of a capital divided by profit is what is 1 by ROE, and based on that 1 by ROE, I can talk about the potential survival time of the company. Means how much, for how much period these returns that are being generated are sufficient enough to make the payment for the debt. So that is what is being talked about as a Wilcox model. The probability of default comes out as the ratio of probability of losses to the probability of gain raised to the power of 1 by the ROE of the firm. Now, for this kind of models, there are many practical limitations, so I cannot put them into practice in real world. But otherwise, there is one valid model which is a structural form model, We'll discuss them again at a later point when we talk about the structural model, which is a Merton model, which is one of the bases for finding out the probability of default, which is saying that the company will survive if and only if the operational flow of funds is at least equal to or even greater than the interest that needs to be paid and principal that needs to be repaid. Straightforward model, right? So whatever the business is doing, so basically if it is able to create an economic value add, whatever the business the company is doing, if it is able to generate funds in such a way that they are able to cover the interest that need to be paid as well as the principal that needs to be repaid, at least that much portion, whatever needs to be paid, both in terms of interest and principal, if the company is able to generate the funds which are covering the interest and the principals that need to be paid, I am saying that the company is surviving. Only if the funds that are generated are falling below what has to be paid as interest and principal, that is where the companies may go into default very badly. So that's one more approach. We will discuss this approach in detail at a later point in this session itself. Then we also have the 4C's approach, again a kind of a framework kind of stuff, which talks about the character of the borrower, the amount of capital that is being borrowed, the coverage, and the collateral, what has been kept as a collateral for the borrowing. So the 4C's typically assess what is the level of default or what is the probability of default that is associated with the borrower. Similarly, one more framework that can help us, especially in banking system, is the CAMELS approach, where we talk about looking at the capital adequacy, which talks about what is the proportion of capital. Again, in a banking system, we use it very heavily. What is the proportion of capital to the risk-weighted assets, which is what we are calling as capital adequacy. So a measure of capital adequacy, the quality of assets that are being used, right? High quality liquid assets are probably, I am talking about a lot of assets which are illiquid. So I am trying to assess what is the quality of the assets that I am having. Then we talk about the management, the quality of the management, the earnings quality, where we are talking about the earnings before interest and tax, or even the net income, which is the earnings after tax. We are looking at the quality of those earnings. We are looking at the consistency of those earnings. We are looking at the volatility associated with those earnings. Then the liquidity factor also would be considered, to what extent or how quickly can an asset be converted into cash without compromising on the price too much. That is what is a measure of liquidity. So we are also assessing the liquidity of the firm while deciding the probability of default, and even the sensitivity of the assets. So this is one more approach that we have. Similarly, one more framework for assessing the probability of default is the LAPS approach, where I am looking at the liquidity of the firm, the activity ratios associated with the firm, which are the turnover related ratios, the profitability related ratios are something that I am looking at, and finally I am also looking at the capital structure. So if you look at, these are the 4 dimensions of different kinds of ratios I calculate. The liquidity ratios, looked at as current ratio, quick ratio, etc. I have activity ratios, or the different kinds of turnover ratios which I can compute from the financial statements. The profitability ratios, talking about return on equity, net profit margin, etc. and the capital structure related ratios where we are bringing in the debt to equity component. So these four really assess what should be the probability of default, or how much should be the default that should be associated with a particular borrower. So there are different kinds of methods that you can talk of, right from the judgmental and subjective based approaches to quite objective and mathematical and statistical driven approaches for assessing the probability of default. Then we are also talking about understanding what is a rating migration matrix. This is something that is used by the rating agencies. So let me give some kind of clarification in this. First, let's understand. I'm using the word called names inside, which talks about number of issuers, which are number of lenders altogether. Sorry, number of borrowers. Number of issuers is nothing but number of borrowers. Then I'm also talking about depth. So the number of names, which are number of borrowers who have defaulted in the time horizon. So I may consider a time horizon of, let's say, 1 year. I'm talking about number of borrowers, let's say 100. I'm also talking about number of them who have defaulted, let's say 3. So that is the depth. So PD talks about what is the probability of default. Now, a few important points in this context. The default frequency in the horizon K, right from time T to T plus K, which means for a period of K period, I want to find out of the total number of borrowers that are there, how many of them have defaulted. So the defaulting people between T and T plus K divided by the number of borrowers who are there at the time T. So this is what we are talking about, the probability of default for a time horizon K. And the same thing I can do a cumulative up to time period K, which means right from period 1, period 2, period 3. So which means when I am starting at T, I am looking at between T and T plus 1, what is the proportion of default? T and T plus 2, what is the proportion of default? So all that put together is what we are calling as the number of counterparties who have defaulted between time T and time T plus K. So we are looking at someone who has defaulted within 1 year, 2 years, and so on. So which means given the sequence of default rates for a particular class of companies, right? When I'm saying particular class of companies, so highly defaulting, so this is where the ratings are coming into picture. So we are getting the default rates for a given class. So here we are talking about the classes as AAA, AA, A, and so on. We are also looking at cumulated default frequency on a horizon K. So within 1 year, within 2 years, within 3 years, what is the kind of defaults that are typically occurring? So when I am talking about a marginal default, it is just between these two periods. So overall between T and T plus K, what are the number of defaults that have occurred? Minus up to time period T, how many have defaulted? That is what is telling how many have defaulted between T and T plus K. So those are the number of parties who have defaulted between time period T and T plus K. So that is how we calculate the marginal default rate. Then we are also computing forward probability. So assuming that a particular firm has survived up to time T, what is the probability that it is going to default within the next K period? So I am talking about overall default up to time T plus K minus the number of firms that have defaulted up to time T. So this difference will give me the firms that they are going to default between T and T plus K divided by the total number of firms which have survived up to the time T. So if I want this, I can compute it as a probability of default, which is cumulative up to t plus k, minus the probability of default cumulative up to time t. And by the time t, because some of them might have already defaulted, I'm only taking at those number of companies which have simply survived, which is 1 minus the probability of default cumulative up to time t. Up to time t, those many firms have already defaulted. Only the remaining number of firms are the ones that are still existing and they are not yet defaulting. Now this is what I am calling as a forward probability between this time to this time. And now when you are talking about overall cumulative up to time t, we are simply expressing it in terms of the forward. Okay, 1 year forward, 1 minus the probability default, 1 year forward, 2 years forward, 3 years forward. I take all of them out and finally do 1 minus, which simply says this is the cumulative probability of default up to the time period t. So this is actually defaulted in time period 1 multiplied by out of those who are surviving in time period 2, what is the probability of those that are defaulted in time period 2, so on, so on. So we are talking about defaulted in time period 1, 2, 2, 3, 4 and so on, which is what is giving me what is the overall probability of default cumulative up to the time period t. Now this is how I'm looking at a rating migration matrix. So based on that, I can very well find out, okay, what is the probability that a firm initially in a triple A rating class will stay in the triple A within the next 1 year, which is 89.1. But the probability that it will go to AA is 7.1%. The probability that it will go to A is 0.6%. The probability that it will default is approximately 0. Right? So this is some of the ways in which I can very well use this rating migration matrix to assess what is the probability that a particular firm will move from one stage to the another stage during a period of a year. So from here we can also compute the annualized default rate, wherein I am simply taking what is the cumulative probability of default up to time t, 1 minus of that, means what is the chance of survival from now to a time period t, what is the probability of survival. So I am talking about survival in period 1, survival in period 2, survival in period 3. So we are talking about the survival rate for all the forward periods up to time t. So I will take this survival, and if I want annualized default, so I am just using a word called annualized default rate, and because I have survived for a period of t, I am taking the annualized default rate, 1 minus annualized default rate to the power t is same as the cumulative survival probability. Now based on that you can do a simple mathematics. So which will work out as 1 minus ADR to the power t is this much. So ADR to the power t will work out to 1 minus of the tth root of the survival rate, all the forward survival rates. And we have already talked about survival rate is nothing but 1 minus the probability of default cumulative up to the time period t. So that is how we can very well compute in the case of default. And the same thing in case of continuous, we know that 1 minus probability of default, instead of 1 minus ADR to the power t, we will write it as e to the power of minus ADR t. Based on that, I can also find out the annualized default rate. So depending on whether I am considering the discrete case or the continuous case, the annualized default rate is computed accordingly. So just look at a small example. I think this should give a lot of clarity for us. Okay, take this scenario. Initially we had 1000 names. I'm talking about a 5-year period, right? So in the first year 10 companies have defaulted. Means there are 990 that are left. And in the second year, this is a cumulative. By the end of the second year, 22 of them have defaulted. Means by the end of second year, you have only 978 of them. By the end of third year, another 13 have defaulted, making the tally to 35. So the total number of companies at the end of the third year is 965. And that's how even the fourth and the fifth years are going. Now let me do my first calculation, which is the probability of default cumulative. So this would be nothing but 10 by 1000, 22 by 1000, 35 by 1000, 50 by 1000 and 70 by 1000. This is the cumulative probability of default up to time t. So cumulative probability of default for 5 years is 7%. Cumulative probability of default for 3 years is 3.5% and so on. Then I am talking about the marginal probability for that particular year. So because I am talking about for that particular year, I'll subtract it from the previous year. So for the first year it will be same as 1. But for the second year it is 2.2 minus 1.1, making it 1.2. The next year 3.5 minus 2.2, making it 1.3. 5 minus 3.5, 1.5. 7 minus 5, 2. So this is the marginal probability of default from one year to the other. Then I am talking about the probability of default forward. The forward probability of default is nothing but I am looking at, okay, for the first year it will always be the same. But in the second year it comes out like, okay, 22 defaulted at the end of second year, by the end of second year. 10 defaulted by the end of the first year. So 12 have defaulted in the current year out of not 1000 but only 990 who have survived. So it is basically like marginal probability for that year divided by the number of names that have survived at the beginning of the period. So here you could see for the third year if I have to do it is 13 divided by 978. Only 978 were there at the beginning of the third year. Out of those 978 that are there, 13 of them have defaulted in the year. So the forward rate comes out to be 13 divided by 978 here. Here it comes out as 15 divided by 965. And here it comes out as 20 divided by 950. That is how you compute the forward rate. Then I am talking about the survival rate cumulative. Cumulative survival rate is nothing but from the cumulative probability of default you do a 1 minus. So 1 minus 1% is 99%, 97.8%, 96.5%, 95% and 93%. Similarly, when I am talking about forward survival rate, I am going ahead with respect to the marginal rates. I am going based on the marginal. So 1 minus of the marginal is what is giving me the forward survival rate. 99%, 98.8%, 98.7%, 98.5%. So it is 1 minus the probability of default forward. So that is what is giving me the survival rate, and I can very well find out the annualized default rate based on discrete or continuous, where I can use this formula directly. 1 minus of the teeth root of 1 minus cumulative probability of default. I can take 1 minus cumulative probability of default and I can take the teeth root of that to get what is the annualized default rate in the discrete time as well as in the continuous time. You can use all these formulas to get a hold on the various default frequencies that you typically need to compute. Then Then moving on to the rating agencies assignment methodologies, both for issue ratings as well as issuer ratings. So there is a systematic survey which is run understanding all the possible drivers of default risk. So there's a big survey that is performed when rating agencies are typically doing the issue as well as issuer ratings. There is a proper systematic survey on the various drivers of the default risk. So there are model based where formula based kind of mechanisms are developed, and in some cases expert based judgmental based approaches are also there, and it would generally be a combination of both of these approaches. And here is a conflict of interest. Most of the times, if you simply see the major revenue source for the rating agencies, it is based on the issuer's fees. See, the main revenue model for the rating agencies is purely based on the fees that is paid by the issuer to get themselves rated. So it might be possible that the conflict of interest could be there. If the issuer is paying more for the rating, probably a better rating could be given, and if the issuer is paying much lesser, probably a worse rating could be given. So there is a possibility of a conflict of interest between the rating agency and the issuer of the securities, because issuer would be paying the rating agency for getting themselves rated. So there is a possibility that the rating agency might compromise on its ratings and give a kind of a rating based on the amount that it has received in the form of fee from the issuer. But let me tell you, in reality that may not occur, because both the reputations, both the rating agencies as well as the issuer's reputations are very highly at stake. So it might very well be possible that that kind of collusive deals may not happen on a larger scale. So that's where we can comfortably omit that particular possibility, though there are instances of such kind of things occurring in the past. So there is information asymmetry, right? One of the other reasons that I have to attribute the same, there is information asymmetry among the market participants. Let's say we are talking about the investors. Not all investors have a good understanding about the market, right? Some of them blindly go with rating agencies' ratings. They don't have too much of an understanding regarding the credit worthiness of a particular counterparty. Whereas on the other side, the rating agencies are supposed to be highly knowledgeable on this issue. So there is an information asymmetry. Not all market participants have similar kind of knowledge about the various products. So they really rely on the external rating agencies' ratings while they are taking their investment decision. So if they really come across that a rating agency has compromised in its rating process, and it is nowhere a trustworthy kind of a rating agency, probably the whole entire trust of the investors would be lost forever, and their entire reputation will be at stake. So there is a very good possibility that the rating agencies will not compromise in terms of giving a favorable rating just because they are charging a high fee from their customers. So if you look at the decision making process for assigning a particular rating, initially the issuer comes out with a request. Please rate my company. So there is an initial evaluation that is performed by the agency, and based on that initial evaluation, there is a detailed meeting that happens with the management of the issuer. And once that meeting has happened, there is a detailed analysis that is done, and there is a rating committee that is formed, which will review the various activities of the issuer and based on that they get into a voting process. And once the entire rating process is done, the issuer is given a notification regarding the typical credit rating that the issuer would be getting from this rating agency. Then if the issuer is fine with it, there is a publication and the dissemination of the rating opinion. So the issuer is conveyed the rating that is being given by the company, and there is a kind of a monitoring and surveillance of the rated issuers and the issues. And again, there is this goes as a loop. There is a feedback loop. Rating committee again reviews it at periodic intervals, and if something has to be improved or something has to be downgraded, the actions are typically taken accordingly. So that's how the overall rating assignment process and the background work behind it take place. So the various assignment methodologies, they are differentiated based on the nature of the counterparty. So is the rating meant for a company or a corporation? Is it meant for a public sector unit? So the methodologies will differ depending on whether it's a company or is the rating for a country as a whole, or is it for a public sector agency. So the methodologies are going to differ based on the kind of entities that are getting assessed. Even for different kinds of products, there are different assessment methodologies. For bonds, the methodologies are different. For structured finance, the methodologies are different, like collateralized debt obligations, collateralized loan obligations, mortgage-backed securities. For these kind of securities, the way the ratings are assigned is different from the ratings that are assigned for traditional instruments like bond. Now, when they are giving the final ratings, they are giving based on the two major analytical areas. Understand the business risks, understand the financial risks. So when I'm talking about the business risks, all risks that are associated with the operations of the business, country in which the business is being performed, the state, the jurisdiction, the industry in which the business is typically getting performed. What is the market share of the company? What is the position of the company vis-a-vis the competition? What is the level of profitability of the company vis-a-vis the industry? What is the peer group? All these things and the risks associated with all these factors come under the business risk. Whereas the financial risk is purely coming from the practices that the company is following with respect to its accounting statements, the kind of governance aspects that are happening within the firm, the risk tolerance levels of the firm, financial policy, the adequacy of the capital, everything to do with the real financial movement. The capital structure, the debt to equity ratio, the liquidity structure of the firm, all these are typically coming as a part of financial risk. So these are the two major assessments, and based on these assessments, the companies are typically giving a final rating. So various financial ratios are being used, right? Profitability ratios are typically used from the historical as well as based on the projected operations, revenues, expenses, taxes, etc. Lot of coverage ratios are typically computed, right? To what extent the cash flow from operations is sufficient enough to pay back the interest and the principal as and when required. What is the kind of interest coverage ratio? Or we talk about the debt coverage ratio, which talks about to what extent again the cash flow from operations is sufficient to repay the interest and principal. So those kind of ratios are being looked at, and also liquidity ratios, talking about how quickly the firm is comfortable in terms of paying off the short-term liabilities with the short-term assets. So all these are the various mechanisms that are typically taken by the rating agencies for the assessment of a credit rating to a particular firm. And various other areas are also being evaluated. I can quickly read through the stuff: the reputation of the management, the reliability of the firm, the experience, how long has been the firm in the business, how has been the performance of the firm over the last few years, the strategy, what is the level of consistency of the strategy, how much it is varying its strategy regularly, and is the strategy in line with the organizational goals, or to what extent there is a deviation. Competitors, to what extent the company is responding to the competitive needs, what is the level of diversification of the business, various sources of cash flows and profits, what is the level of concentration and the diversification of the firm, to what extent the firm is resilient to business volatilities and any kind of uncertainties in the market and the economy. All these are various things that are typically considered by the rating agencies. Apart from that, they also focus on the governance quality. To what extent the board members are competent, and what is the level of integrity of the board members and the management. What is the level of concentration versus decentralization of the decision powers within the organization. How is the power really distributed across the various layers? Does the company have succession plans in place? What is the way the handover of the responsibilities happen typically, especially for all the key resources at the management level? What are the processes in place when an employee is leaving an organization or typically going out on a vacation? How is the work typically taken care of? All these things come under the assessment of the credit rating. These are all becoming one of the some of the core factors that would be considered by the rating agencies while they are issuing the credit ratings. Similarly, the other dimension comes from the environment, technology, the production process, compliance, sustainability, legal risk, institutional risk, political events, to what extent all these are vulnerable to the various political events. And finally, there is a possibility to look at the various embedded hidden liabilities. What are the kinds of various insurance aspects that are there, the pension plans that are there, the healthcare services that the company is providing to its employees, right? The various bonuses that are given by the employer to its employees, the ESOPs, employee stock option plans. All these things are typically looked at by the rating agency into consideration when it is finally considering the credit ratings, final credit ratings that need to be given to these firms. Now, once it has given some kind of a credit rating to a particular borrower, there is a kind of a linkage between the rating and the probability of default. So all those companies which are carrying a similar kind of a rating, which is the typical homogeneous population, I'm simply looking at within that entire homogeneous population, what is the actual frequency of the companies which are defaulting, because it's very much assumed that under the assumption that all these firms are more or less homogeneous based on all the other factors that are being considered earlier. So all these are typically treated as homogeneous, and based on this level of homogeneity, we are trying to match within these number of homogeneous firms what is the frequency of the firms that have typically defaulted. So that actual frequency is a good measure for a prediction. That's a good starting point for the prediction of what would be the typical proportion of firms in this particular homogeneous category to default within the next 1 year. So that's how the predicted probabilities are coming from the actual experience of the probabilities based on the frequencies per each homogeneous rating class. And even apart from finding out the probability of default, even the migration frequencies, we have seen a table in the couple of slides earlier. So this is a kind of a homogeneous class. Let's say AAA is a homogeneous class. Within that, we are observing within all the AAA rated firms, how many of them typically defaulted within 1 year. So that would become the kind of a probability for the futuristic prediction of these could be typically the probability of the number of firms that can default for the next year. So that's how the based on the probability based on the rating that is being assigned, that would be treated as a homogeneous category, and depending on the actual frequency of the firms that have defaulted from that category, the frequency of the default would be computed, and along with that we will also check what is the proportion of the firms that have migrated from one rating category to the other rating category within a particular period. So that is how the rating migration matrix also is typically computed for us. So now that we know that these are the ways in which I am looking at expert based rating mechanism versus the agency based rating mechanism, we can clearly see those mechanisms, generally expert based ones, are very highly judgment based. So if they are judgment based or expert based, there should be a huge amount of experience that has to go into it. I should spend years and years in terms of understanding different kinds of systems where the defaults are occurring. There should be a repetition of the entire process so that I gain more and more experience. That is where my judgments are getting more and more converged. So that goes into the expert based systems. Whereas when I look at the overall patterns of the organization, they are never static. They keep changing. The way the businesses are done keep changing from time to time. So the organizations keep changing to market conditions. The market conditions keep changing means the way the organizations are doing the business keeps changing from time to time. The growth periods also, right? There are some periods which are very much expansionary periods, whereas some periods which are driven by recessionary kind of scenarios. There are various conditions that alter the process. We talk about mobile banking, internet banking, various processes that are altering the overall way the typical banking operations are being performed. The customer segments are changing from period to period, right? And even the appetite for risk. There might be a scenario where at a particular point in time, an organization would be a highly risk taking, but after a few number of years, the risk taking ability of that same firm might have gone down drastically, or it could be vice versa. So all these things need to be really considered while the ratings are taken into consideration. Even in some cases, because of the mergers and acquisitions, probably a high risk firm would be merged with a low risk firm. So the overall credit portfolios that are getting merged, they would also belong to quite opposite kind of groups. Even the way in which the credit approvals are done, high risk versus low risk, risk taking versus risk averse, all these kinds of things could change, which means the way the ratings have to be assigned to all these firms also need to change on a dynamic basis. Even the culture of the company might change. The skills of the experts, the business lines in which the company is operating, the frameworks, all of them can keep changing. So accordingly, the ratings also need to change. So which means internal expert based rating systems and agency based rating systems, these are some of the cases where enough care need to be taken. When I'm talking about a few of these things out here, measurability and verifiability, agencies ratings can be easily measured and verified almost 3/4 is covered with saying. So there is almost 75% of it can be measured and verified. Whereas internal experts based rating systems, it is purely based on the judgment that they are giving based on their own experience, means the verifiability is not that strong there, and even the measurability will be very, very weak. So on that case, agencies based rating is much more comfortable. The same logic when I talk in terms of objectivity and homogeneity also, the ratings given by the rating agencies are more objective because they are considering wide variety of business parameters as well as financial parameters to give their ratings. So there is a good amount of objectivity in the agency's rating, whereas there is a possibility of biasedness in the expert based rating system. And when it comes to specificity, where they are trying to differentiate based on the levels, probably the specificity is much higher in case of agencies rating, but in some cases it may not be possible in an expert based rating system. So that's how we will understand these two broad areas of rating systems. Then we are moving on to the next stage of these rating systems, where we are bringing in the statistical kind of mechanisms. We are using different kinds of statistical techniques to typically do the probability of default or to assess the default of a particular party. So the structural approaches, they have a well-defined path to default. Right? When we are talking about structural approach, they have a streamlined formula-based mechanism which would end up computing the probability of default. Out of the many approaches that are there, the most popular approach is the Merton model, where the probability of default is directly computed based on the structure of the organization. Right? Probability of default is purely computed based on the balance sheet or the financial statements of the firm. The financial statements of the firm will be the input to compute the probability of default in case of the Merton model. So they are based on economic and financial theoretical assumptions. So we look at the various economic factors as well as the financial performance factors to finally compute the probability of default. So it's an estimate of the formal relationships based on a theoretical model. So we are using here a Black-Scholes Merton model, right? So it's a kind of a theoretical model based on which we are trying to assess the probability of default. Whereas in case of reduced form approach, it is I am making a blunt assumption on the various variables. I am deciding which variables are going to impact the default. So I am making assumption on all the important variables that would be affecting the default. Right? I'll say market volatility could affect the default. Management behavior could affect the default. The cost could affect the possibility of default. I'm trying to make a list of assumptions on all the variables which are going to impact the probability of default. And based on that, I'm using different kinds of statistical techniques where I'm mapping the default or not default with the various factors that I think are going to influence the default and building a kind of a statistical model between them. So I'm not going with any kind of a theoretical framework, no conceptualities. I'm just bringing in based on my brainstorming. I'm simply bringing in all those variables that could play some kind of a role in the default, and based on that I'm trying to build relationships between them. So regarding the various drivers of default, not too many assumptions or theoretical bases are typically being made. So the intention is to increase the predictive power So add your variables in such a way that the overall predictive power is going to increase. So the relationships are purely estimated with that sole objective where my predictive power has to be increased in any stage. So the model that I am using is basically determining what is the probability of default. So a wrong choice of model could lead to wrong decisions altogether. So that is where we are talking about a possibility of a model risk there. So the way in which I am designing the model could really make or break the goodness of fitment of the model for the prediction purposes. So we have different kinds of credit risk models which are based on reduced form. So I will be talking about linear discriminant analysis based models or logistic regression based models which come under the reduced form models. And we also have one of the most important discriminant analysis based model, which is the Altman Z score, which is also a kind of a reduced form model, because the Altman Z score also makes a assumption regarding the parameters that are going to influence the default. So it says 5 different factors are going to influence the credit worthiness of a company, right? One talks about the retained earnings of the firm to the total assets of the firm. Similarly, the sales to total assets, then working capital to total assets ratio, then market value of the equity to the book value of the debt, and even the EBIT, which is earnings before interest and tax, to the total assets. So these are the 5 parameters that are assumed to typically influence the default or the credit worthiness of the firm. So because the number of factors that are typically playing a role is already frozen beforehand itself, and an appropriate statistical model is being built to link the default versus non-default of a particular counterparty. So this also would come under the head of the reduced form model. So now that we understand the difference between a structural model and a reduced form model, we will look at some of the most common structural and the reduced form models. We'll take examples of them, and based on that we will differentiate between these two kinds of models. So we will talk about the logistic regression based, the Merton based model, and the linear discriminant analysis based model. And after that we will get into the comparison of all these various approaches. Alright. Now let's get started with the structural models, where my intention is to understand the default risk. So these models, as I have already said, they are based on the overall value of the firm. They look at the value of the debt and the value of the equity put together as the value of the firm. And they assume that default is nothing but the deterioration on the value of the firm. And when the value of the firm has gone down drastically, in such a way that the value of the firm is much lesser than the amount of debt that they have to pay, this is where we say that the firm is going into default, because the whole firm itself is having a value which is lesser than the amount of debt that it has to pay. So this is what we are terming as the situation of default. So if I go with that kind of a definition, the corporate securities, I am looking at them as options on the value of the issuing firm. The equity, here when I am using corporate security, I am typically calling it as equity. Equity is being seen as an option on the value of the issuing firm. So we'll see why we give that kind of a definition to equity. We say that equity is a call option on the value of the firm with a strike price equivalent to debt that the company has issued. So we'll try to come out with that kind of a definition slightly later. But let's try to understand. We are using the typical option pricing formula, which is the Black-Scholes formula, to price equity and debt using this kind of a model. So to find out the worth of the equity, the worth of the debt, we are simply using the option pricing formulas. Once I know the firm value as well as the capital structure, which is the debt to equity ratio. So we are simply finding out the value of the firm. There is a mechanism. So I can very well find out the value of the debt and the equity using the option pricing formula. Or if someone has already taken the equity from the market, right? So I can very well find the value of the firm from the quoted equity from the market. And based on that, I can even compute the probability of default as well. We'll take an example slightly later. So I can very well do two things using this Merton kind of a model. I can either find out the value of the equity as well as debt by taking the firm value and the capital structure. I'll use the simple Black-Scholes option pricing formula for that. Whereas on the other side, if I take the market price of equity itself, based on that I get the value of the firm, and based on that I should be able to compute the probability of default of a particular company, right? And today there is a lot of popularity that is going up for these kind of models. Almost it's a market standard in the field of default risk, and there are lots of improvements that have come out because a few limitations are identified as a part of the Merton model. So different kinds of improvements have come out, refinements have come out on the Merton model. So all those are forming an important part in the assessment of credit risk today. So let's get started with the Merton model. So as I have already pointed out, it's an application of contingent claim analysis to the corporate security pricing. So what is that it is happening here? I'm taking a firm whose current value is V, and I'm assuming that there are two sources of financing here. One is equity, which is having a value of S, and pure discount bonds means single maturity, which is a maturity T, and pure discount bond. So zero coupon bonds. Zero coupon bond with a maturity T having a current value of P is other source of financing. So I am not taking coupon bonds here, or I am not taking bonds of different maturities here. That becomes the limitation of the Merton model. When we talk about the limitations, we'll bring all of these things in. But what the Merton model has simply assumed is a firm whose value is V, it is assuming that it is financed through equity whose value is S, and pure discount bonds whose value is P, which are maturing at time T. And the principal that has to be paid at the end of the time T is some K. The principal that has to be paid at the end of time T is K. The present value of that is what we are calling as P. Then it is also making an assumption that at any time T before the maturity, The value of the firm at that particular point is nothing but it's the sum of the value of the equity and the value of debt, which is the debt is purely in one single firm, zero coupon bonds which are maturing at time t. Now a few more assumptions have been brought out by this model. See, in general, if I sense that this company is not going to perform well, I can start forcing the firm into bankruptcy. But what the Merton model is saying is the bondholders will not force it into bankruptcy before the maturity of the debt. So if at all they have to force this firm into bankruptcy, it has to happen at time t itself, not before that. Right? That's one assumption the model is bringing out. And so when I'm waiting until time t, I'm simply looking at that point in time, is the value of the firm, which is Vt, sufficient enough to repay the debt. So at that point in time, the debt that has to be paid is the principal itself. So is the value of the time at that particular point in time sufficient to repay the debt? Then we say the firm is solvent, else we say it is insolvent and a default is going to come. So that's a simple assessment that we are doing using this model. And coming to the way the value of the firm is assumed to move, this model made an assumption that it follows a geometric Brownian motion. Means a small change in the value is mu times, there is a drift portion as well as the volatility portion. And we know that this kind of representation dz is nothing but a standard Brownian motion. And we are assuming that the change is because of the drift, which is changing at the rate of mu, drift coefficient, and the standard deviation is sigma times v, dz being a standard normal variable. So this is how we are assuming that the value of the firm is going to change. And as I have already said, if the value of the firm at time t is insufficient to repay the debt capital, then we are saying that the firm is defaulting, which means the bondholders actually will be receiving only Vt here, though they have to get D at this particular point because the firm value is not up to the extent of D. The bondholder is going to receive the whole value of the firm and the equity holder is going to receive 0 because the priority is always to the bondholders. So here again an assumption is being made that there is no kind of negotiation that is existing between the equity holder and the bondholder. So we are directly making an assumption that the bondholders are going to receive the entire Vt. But in case we are seeing that the value of the firm is greater than that of the debt, then the bondholder is going to receive whatever he was due, which is the amount of debt, and the equity holders are going to receive the remaining of it, which is the Vt minus D. So if I am looking at the payoff for the bondholder, it would be the minimum of either K or Vt, whichever is smaller. So they would be receiving one of these two, or I can very well write this as K minus of maximum of K minus Vt comma 0. Now this is where I can try mapping the options terminology. Okay, K is nothing but the risk free, right, which is nothing but the risk free bond, because K is the principal on the bot. So we are talking about I am going to get that bot minus means I am taking a short position, max of K minus Vt comma 0, strike price minus the market price. So this is what we are calling as a put option. So I'm having a risk-free bond plus a short position in the put option on the value of the firm with a strike price equivalent to the value of the debt of a single zero coupon bond. So that is what is the equivalence of the payoff for a bond investor or for a debt. And the same logic if I'm talking about for equity, they are going to receive either 0 or Vt minus K, whichever is higher. So this is a perfect payoff associated with a call option. Right? This is a perfect payoff that is associated with a call option. So that's the reason we are saying payoff to the equity holder is similar to the payoff of the call option on the value of the stock, on the value of the firm for a strike price equivalent to the value of the strike price equivalent to the face value of the debt. And I could clearly see from the bondholder's standpoint, it's a payoff. One, having a riskless bond along with a short position on the put on the value of the firm with a strike price equivalent to the face value of debt. So that's the reason the typical call option graph is what is being shown here as a payoff to the shareholders. A put option, a short position in the put option along with a risk-free bond is what we are showing as a payoff to the bondholders. So that's the way the Merton model has been designed. Now, because everything is going in line with the application of the Black-Scholes formula, and we have also said equity, I can take it as a call option on the value of the firm with a strike price equivalent to the face value of the debt. Now almost every information is there with me. So I can very well find out the value of the equity using the Black-Scholes formula. Again, the formula is used in different ways, but I can very well define in a simplistic way for you. Okay, value of the firm, value of the equity ST at any point in time. Okay, the spot price, which is the value of the firm times ND1 minus the present value of the strike price K e power minus RT times ND2. Here RT is the time to maturity. So probably write it as T minus T. And here my definition of D1 goes with log. Here S is what we take as Vt by X, which is the strike price. I take it as K plus R plus sigma is the volatility of the firm, sigma squared by 2 times T divided by sigma square root of T, and D2 becomes D1 minus sigma root T. Again, sigma is nothing but sigma V here. So I can very well use this kind of a formula to arrive at the value of the firm, value of the equity. The value of the equity I can arrive at this particular using this particular formula. So N dot is talking about a cumulative normal distribution. and this whole formula is trying to build a relationship between the fundamental value of the firm and its security. A few important assumptions that are going into this model. At any point in time, the company is having a very simple capital structure. There is an equity, and the debt portion is nothing but one single issue of a zero coupon debt which is maturing at time t. That's a straightforward assumption that is typically coming out. Then value of the firm, it is assuming that it is perfectly observable, but it's not so in real time, right? Because the debt is not that actively traded in the market. So it might very well be possible that the mark to market value of the debt is difficult to obtain on a day-to-day basis. But this model assumes that the value of the firm is a directly observable element. And as we have already talked about, the value of the firm follows a geometric Brownian motion, which is a log normal diffusion process. So there is no question of any kind of jumps in the model, which means if at all the company has to come to a default situation, it has to come gradually, but it can't come with a big bang. But in reality, we are seeing that within no time the companies can go into default. But this model is assuming that the companies can go into default only in a gradual manner. And default cannot occur anywhere in the middle. It has to occur only on the date of the maturity of the debt, which may or may not be close to reality at all. And whatever I am taking as the risk-free rate of interest are throughout the time and maturity, I assume that it is constant, which is again an assumption that may not be relevant to a large extent because the interest rates keep changing from time to time. And this model does not allow any kind of debt renegotiation between the debt and equity investors. Generally, whenever there is a kind of default that is being sensed, there will be some kind of a renegotiation that can happen between the debt and the equity investors. Otherwise, what happens is the debt investors are going to receive the whole amount and equity investors might end up receiving zero. So there could be some level of renegotiation that can happen between the parties, and a different deal might be struck between them. But here the model is saying no such kind of stuff exists and no liquidity adjustment. So with these kind of assumptions, this model is perfectly able to use the Black-Scholes option pricing formula to come out with the value of the equity. Now, when I use the model from the real world perspective into the real world applications, a few practical difficulties are cropping up. The value of the firm is very difficult to find out because the mark to market value of the debt is generally unknown. So once and we have already made an assumption that the value of the firm is nothing but the value of the debt plus value of the equity plus debt. So this market value is straightforward, whereas this market value is much difficult to obtain. So which means this market value is not that easily observable. And along with that, there are a few elements on the balance sheet like goodwill and off balance sheet elements. They are not that easy to be measured on a regular basis, which means the value of the asset, the book value of the assets is also slightly difficult to work out. And whatever the volatility that I am talking about of the assets, even there it's not that easy to obtain because of the low frequency of the observation. So because of different such kind of scenarios, the Merton model for a practical usage might have its own set of limitations. So there has been some kind of an improvisation that has come over the Merton model, which out of which the KMV credit monitor model is much more popular. And practically, if I see, rather than finding out the value of the debt or value of the equity, the Merton model has been more and more heavily used for finding out the probability of default. We'll take an example as to how Merton model has been used for predicting the probability of default and how the KMV model has brought out an improvisation on the top of it. So the KMV credit monitor also, it is using a similar kind of an approach. The equity based model, which is the Merton model itself, and its intention is also to compute the probability of default, but here it is trying to compute the probability of default using its own set of algorithm, which is more and more proprietary. The reason being, it has found out two major issues that are existing with the Merton model. How should we calculate the strike price of the call? We said the value of the debt, but this value of the debt we simply said as one single zero coupon bond. In case of Merton model, we said that it is one single zero coupon bond. Now this is where the KMV model came out with a kind of an objection. How do I really ensure that this model I can use for different coupon bonds? Different coupon bonds, different maturities, can I use this kind of a model? Now this is where instead of using this D or instead of using this K, which is the face value of the debt at the maturity T as the strike price, they came out with a different mechanism to compute the strike price. They were not willing to use the single zero coupon bond face value as the measure of the strike price for the call option. But that is one point which the KMV model focus more and more on. And further, they have come out with some rule of thumb, which I am going to discuss. Okay, we can go down to see. They have come out with the definition of the strike price at the point of default. They are calling that the strike price at the point of default, wherein the whole debt, whether they have classified the whole debt, different kinds of bonds the company has issued, either into long term or short term. Now, let's say I am choosing the probability of default in 1 year. If I am choosing a time period of probability of default in 1 year, then what we are simply saying is, if the maturity of that particular bond is less than 1 year, they are calling it as short term. If it is greater than 1 year, they are calling it as long term. So they have come out with a model wherein the whole set of bonds of the company are classified either as short term or long term. And based on that, they are coming out with the computation of the strike price at the default point, the value of the asset where the firm is going to default. They started coming out with an empirical result saying that the default value is nothing but the short-term debt plus 50% of long-term debt. If the long-term to short-term ratio is less than 1.5, and this, otherwise they said short-term debt plus this. If you really look at it, this is nothing but short-term debt plus 0.7 long-term debt minus 0.3 short-term debt, which is also a simple way of saying 0.7 times short-term plus long-term. Right? Either it is short-term plus 50% long-term, or it is 70% of the total. They have come out with two different kinds of mechanisms of computing the default. If the ratio long term to short term is less than 1.5, they are simply saying short term plus 50% of the long term is the default value, is the value of the assets where the bond might default. Whereas if the LT to ST ratio is greater than 1.5, they have specified it as 70% of the total. Again, there is no theoretical base to it. It's purely empirical in nature. So they have used some kind of a rule of thumb to compute the strike price of the default at the default point. Then another issue that they came out with is how do I estimate the drift and volatility of the asset value. The Merton model has typically said that the value of the asset is going to follow a geometric Brownian motion, right? But these people, they don't want to go with that kind of an assessment, because one, how can I make an assumption if it is even unobservable altogether? How can I assume that the process follows a geometric Brownian motion when I am not even able to observe the market values of the asset at all? So they have used some of their proprietary undisclosed methodology to come out with the computation of the volatility. They are not using the volatility which has been used by the Merton model from the equity prices and all. So they are using their own proprietary undisclosed methodology for computing the volatility. Now, this is where I'll try to compare both these models, whether it is the credit monitor model or the Merton model. Let's take one example. Consider a firm. If we substitute it, it becomes more and more easier for us, right? We'll take an example. We'll try to find out the formula. And in case of a Merton model, the probability of default, I can directly call it as n of minus d2. So we'll try to use the Merton model formula. So consider a firm with a market cap of 3 billion. Consider a firm with a market cap of 3 billion. Okay, the equity is coming out as 3 billion and equity volatility of 40%, or I call it as sigma of the equity. Sigma of the equity, I am calling it as 40%. Short-term liabilities of 7 billion. Long-term liabilities of 6 billion. Current value of the assets. Current value of the assets we are taking as 12.511 billion. Firm volatility. So I am taking sigma of the overall firm. I am taking it as 9.6%. If the expected return on the assets R is 5%, find the probability of default as per the Merton model in 1 year. The time to maturity, I am taking it as 1. And here, probably let's say I want to use the default, the strike price at default. Logically speaking, I should have considered a single debt, but of course, let me use based on this model itself. Okay, the long term to short term is what I am trying to find out. I see that this number is less than 1.5. So I can very well find out my strike price at the default, which is nothing but the short-term debt plus 50% of the long-term liabilities, which is working out to somewhere around 10. Right now I have the strike price. Now I have the value of the firm, the volatility of the firm, the time to maturity, and risk-free rate of return. Based on this, I can find out first of all my D1. D1 comes out as log S, which is the value of the firm, by X, which is the strike price of the debt, plus R plus sigma squared by 2 times T divided by sigma root T. Alright, this comes out to be my D1. D2 comes out as D1 minus sigma square root of T. Then I'll compute my ND1, which comes out as norms dist value associated with D1, and then I can compute ND2 also using a similar kind of a formula. And from here we are talking about n of minus D2. If I want to find out the probability of default, we say n of minus D2, which is nothing but 1 minus of ND2. So it comes out to be this kind of a number, 1 minus ND2. So the probability of default that comes out through this Merton model is very much coming out as 0.25%. When I am going with the Merton model, it is making a straightforward assumption that the probability of default is somewhere around this. Right, log S by X plus R plus sigma squared by 2 into T divided by sigma root T, D1, D2. So the probability of default is coming out to around 0.25%. So that is what is typically being done using the Merton model. But the KMB model looks at it slightly different. The probability of default, it names it slightly differently as the expected default frequency. Even in that case, they are doing a similar kind of a computation. Even in that case, they are coming out with a similar kind of a computation. First, you find out, don't apply the normal distribution, okay? We have got our D2. Look at your D2. Okay, you have got your D2. Don't go with normal distribution assumption. Whatever the D2 that you have got here, call that as the distance to default. So here the distance to default is around 2.8. So it is not relying anything on the cumulative normal distribution. Right, whatever the computation of D2 here, it is calling as the distance to default. They are not relying on the normal distribution because they have felt that the default probabilities that we are computing using the cumulative normal distribution, they are much lower because we are assuming a normality of the distribution which will actually be a thinner tail compared to the reality. So what it is doing is, whatever, okay, this 2.8 is the expected, or 2.8 is typically the distance to default. Now they have taken from their historical data, let's say 1000 firms. And out of that 1000, for each of the 1000 firms, they are finding this distance to default. And what they are simply looking at is associated with each distance to default, what is the proportion of the firms that have actually defaulted within 1 year. So let's say for those firms which had a distance to default of around 2.8, let's say 2 out of 1000 firms have defaulted. Then what they have come out is, if the distance to default is around 2.8, the probability of default is somewhere around 0.2%. So that is the kind of a mapping that they have done. They have taken the expected default frequency. The way they have come out with their expected default frequency or probability of default computation is, they are trying to match their historical default frequencies recorded in their databases, and the firms are typically classified into those kind of buckets. So that is where they differed. They did not go with any kind of a model. They did not go with any kind of statistical assumption. They have simply took the data from the historical records and tried matching with it. Right? So once they are able to calculate the EDFs, there is even a possibility that they can map it to the rating agency classes also. So okay, if the probability of default, right, probably let's say the rating agencies have given AAA kind of rating to a set of companies whose probability of default is, let's say, less than 0.25%. So I can look at all the AAA companies. Okay, what is the distance to default for them? And based on that, I can very well say that the probability of default for them, let's say, is less than 0.25%. Some such kind of a mapping can very well be done in the real world. But of course, there are a few criticisms that come even on this. Whatever the distance to default or the expected default frequency that we have computed is purely based on at the point in time as of today, and we are looking at the probability of default in 1 year, and that's how we have computed or segregated the short term versus the long term. Whereas when we talk about the ratings, they are not per at the point. They are through the cycle kind of approach, and they generally don't look at just 1 year, they are beyond 1 year kind of period. So they may not be like comparing apples to apples. So that's where sometimes people typically criticize that they can't use the EDFs that are obtained from this KMV model for the rating agency mapping, right? But still, conceptually, you can very well understand the same kind of concept. Then, now that we have comfortably understood the equity based models for default prediction, we'll try to see their usage perspective. One advantage, because the number keeps changing on a day-to-day basis, they can give me early information about the rating migration and default. When is that the company is going into a very high probability of default? When is it shifting from one aspect to the other? So there could be an early information because the equity prices change daily. Lot of things change on a regular basis. So, but at the same time, some negative thing that comes out, let's assume that the equity markets are falling. What will happen if the equity markets are falling? Just look at the formula now. The equity price has fallen drastically. So it could very well result. Let's take from this example itself. So the value of the equity is going to fall. Value of the equity is falling means, let's say the value of the firm is also going to fall. Right? So from 12.511, let me make it as 11.511. the value of the firm purely because the equity market has fallen. Let me decrease the value of the firm. Suddenly, because the value of the firm has gone down, D1, D2 has gone down and probability of default has gone up drastically. Right? That is what I am trying to say. Nothing has happened to the debt market. It's only a general fall in the equity market. But the expected default frequency is going to go up. Distance to default is coming down. So the expected default frequency is going to go up. And many downgrades are happening in the internal ratings, which means though the credit quality of those companies was unaffected, but still we could see that because the probability of default has increased for those kind of firms, their credit ratings can get badly impacted. So this is the biggest abuse that comes using this equity based models. A general fall in the equity market can hamper the credit ratings and credit quality of the company. And the other side to look at is false starts are very much possible because of this. Now people see that the companies credit ratings have gone worse, and immediately they start selling their positions in a market when the equity prices are much lower. So they are forced to sell at much lower prices, adding fuel to the fire. The equity prices are going to go down even more worse. The same logic happens the other way. When the equity markets are booming like anything, probably if I make this 13, when the equity markets are booming like anything, even if the credit position is not that comfortable for the company, credit worthiness is not that heavy for the company, the probability of default is going to come very negligible, which means during a bubble kind of a period, none of the models will pinpoint about the credit riskiness of any particular company because equity is there to cover the debt. So this is where a lot of cautiousness is very much essential. And in reality, economic capital, when it is linked to probability of default, which is calculated based on the equity based models, will tend to be more and more volatile. And because of this reason, the top management of the bank does not want to use this kind of a model. And what we typically see is, in general, the equities will be much higher during the boom period and the value will be much lower during the recessionary kind of a period, which means this model is more and more pro-cyclical. And it is also saying because the equities are more and more, equity value is much more during the boom period, it is also saying that the probability of debt will be much lesser, probability of default will be much lesser during this period, so lend more during this period. Whereas during the recession, the probability of default is going to be much higher. So this is where actually we require debt to boost up the economy. But this model is simply saying during the default, during the recessionary kind of an environment, the probabilities of default are going to be much higher. So there is no point in lending during the recessionary period. But that is where the more lending is required to boost the economy back to the original situation. So that's one of the reasons we could see that, or that's one of the major limitations that we could see with the application of the equity based models for the prediction of default. So just to summarize, today there's a lot of popularity that's going around for the Merton type of models. Lot of banks, they have developed their own systems which bring out early warning information from the market variables. They have different ways of estimating the volatility of the firm. Some of them have developed some models based on the equity of the firm. Some of them have come out with implied volatilities from the option markets. So different kinds of ways in which they have come out in terms of estimating the volatility of the firm. So they have done some small tweakings to their the original model to suit it to their requirement. And equity based models, they reflect the market's view about the probability of default of a specific users. That's the reason these models are very heavily used in the industry, and they are a very good complement to analyzing the firm's fundamentals. So that's the reason the market is using them quite comfortably. There is a lot of usage, though there are a few limitations which we have observed in the earlier slides. But the market is still comfortably using these kind of models because of a couple of benefits or complementing the firm fundamental based evaluation approaches to assess the probability of default. Now that we got a decent hold on the structural models, we are moving further to understand the scoring model. The reason is the structural models are more and more applicable for listed companies because we are looking at the market value of the equity for them. But they do not extend easily to the smaller and private firms. That's the limitation with the typical equity based model. So that's where we are trying to look at some alternative, and the credit scoring models are someone which are applicable in almost every scenario. Now, the way they try to look at is there are two things that these kind of models talk about. They focus on the prediction of the failure as well as the classification of the credit. So any new firm, they focus on one, finding out the prediction of the failure, probability of default kind of stuff, and two, they also focus on classification of that particular credit into a default or a non-default kind of a category. Today it's one of the most widespread technique that is used by the banks, especially at individual retail kind of a level. For processing the credit card applications, today credit scoring model is the most heavily used one. Even for small to medium term enterprises based lending, still the credit scoring models are the more heavily used kind of one. So we are going to look at different kinds of mechanisms. Especially there are linear regression based probability models, Logit model, Probit model, multiple discriminant analysis models, which we are going to look at. Some of the credit scoring technologies that are heavily being used in the industry, they get classified into different such kind of statistical aspects. A few things. Any model that I am choosing, one, it should be more and more accurate. The error rate should be much lesser. So that is how I choose a model. The model should have a parsimony. It should not use hundreds of parameters to finally give me a result. It should use as little number of parameters as possible. What we call them as explanatory variables or independent variables. They should be very limited in number to give me the required outcome. So that's one more important characteristic of a good model. It should produce me an interesting result, which is the non-triviality of a model. It can't give some kind of rubbish as a result. And it should not take years and years to run and give me the result. It should be able to be executed in a reasonable amount of time, and it should be purely based on how frequently or how often I am going to use that particular model. So the model should be very much feasible. There should be a lot of transparency in the model, right? What are the different kinds of relationships between the various data? I should be able to understand it and explain it to others. And where the output is coming from. people should be able to interpret and transparently make some kind of conclusions from the model. So these are the various attributes that are very much essential for any good model that we are developing. And very common set of models when it comes to the scoring aspect. The first dimension is I need to know, we have already said that these credit scoring models do two things. One, they classify the credit into good versus bad, and two, they get into the prediction of the probability of default. Now in this classification, we talk about two different definitions. I want to know whether it's a supervised classification or an unsupervised classification. When I'm saying it's a supervised, we are defining the criteria according to which I want to classify the various risks, the various credits into different groups. Whereas in unsupervised, we are leaving the classification completely to the data itself. The model builder looks from the model. So this classification comes purely from the model, whereas here the classification we already know according to what criteria we want to classify between the groups. And so we are more and more focusing on the supervised classification category itself, wherein we are looking at different kinds of methods that are useful for credit scoring. We are talking about a few front-end models and a couple of back-end models. In the front-end models, we talk about more and more ease of understanding and implementation. So even we can perform it quite comfortably. They have a very good classification accuracy. Wherein we will be talking about two major models called Fisher linear discriminant analysis, and the other one being the logistic regression and the Probit model. Whereas when it comes to the back end, they have a slightly longer computation time. They take more time to execute, but they have a very high predictive performance. So, which means if my objective is more and more of a classification accuracy, I can look at one of these two models. Whereas if my objective is getting more and more into a predictive performance, though I am going to take more time to compute, I can rely on the kth nearest neighbor based classification or the support vector machine based classification, right? And apart from these also we see different kinds of other techniques like neural networks, tree induction method, genetic algorithm. Different such kind of methods can quite comfortably be used. So here in this session we are going to talk about these four different kinds of methods, how they are going to help us in doing the classification and prediction. Though we are not going to go very much in depth into each of these methods, but at least from a functional standpoint we have to understand how each of these methods are going to work. So starting off with linear discriminant analysis. So the objective of this is primarily do a segregation and classification of a big set of data, which are here the borrowers, right? Here I am looking at the borrowers, which is a heterogeneous population. I am trying to group them into homogeneous groups. So probably the homogeneous groups I am calling them as default and non-default. The whole set of population which is having different sets of characteristics, I am trying to group them either into a default or a no default kind of a category. So I am giving a decision criteria and coming out with a relevant decision rule based on which I am identifying the number of classes. See here I have identified, let's say, two classes, default versus no default. I am doing the segregation of the data, right? And with this as the target, I am coming out with a linear combination of explanatory variables. Here for these borrowers, I might take the explanatory variables as age, education level, let's say debt to income ratio, or salary, some such kind of explanatory variables I am taking, and based on these I am trying to come out with a mechanism which is going to segregate the default risk from the non-default kind of categories. So here, if you understand, just as a notation, if I am saying n is the number of data points, which are the number of customers to be classified, or number of borrowers to be classified. P is the number of variables per each data point. So let's say we are talking of these 4 variables based on which I want to classify the customers. X is a vector of observations, okay, for the customer 1. For the customer 1, what is his age? What is his education level? Let's say a doctorate. What is his debt to income ratio? 4.5. What is his salary? Some 100,000. So this is a vector which we are having for each of the observation. And let's say we are dividing the whole data into 2 classes. So the C for me is 2. And I'm trying to find mu I as the mean of the variables. So if I'm looking at the mean of the variables in class I. So when I'm looking at the class I, so the default is one class, no default is the other class. So I'm trying to find out the mean of age, the mean of debt. That is what I'm calling as mu I. And between the classes, whatever is the covariance that is existing, let's say that is what I'm calling as the sigma. Here my objective is to separate the 2 classes W1, omega 1 and omega 2. Probably I'm calling omega 1 as good borrowers and omega 2 as bad borrowers. Now the simple way is, I am combining a linear combination of the explanatory variables. Here, that particular combination I am going to choose, which will create the maximum distance between the 2 classes. So I am taking the classes as no default and default. I am using that linear combination of each of those explanatory variables, where the distance between these 2 classes is the maximum enough. So this is where I am talking about mu1, which is the mean of the first class, mu2 the mean of the second class, and I am multiplying this entire process with the transpose of the WT. Right, I'm looking at the weights. So I am taking appropriate weights, transposing that, doing a multiplication square, and I am dividing it with the WT. WT is the transpose and sigma is the covariance and W is the original vector. So overall here it is coming out as the variance, and here it is coming out to be something like a covariance. Numerator is coming out as the covariance, denominator is coming out as the variance, and this is the one I am trying to maximize. And of course I know that if I have to maximize it, I am differentiating it with respect to the weights, because the weights are the ones I am supposed to find out, and I am differentiating this with respect to the weights and setting equal to 0, which means the weights are typically coming out as the covariance inverse matrix, the inverse of the covariance, and I am multiplying it with mu1 minus mu2. That is how I am getting my matrix of weights for each of the parameters. So this is the mathematical way. Of course, we have software tools or statistical packages which are going to perform this activity for us. So all I need to know is, if at all I have to classify the risks into a good risk versus a bad risk, I am using the Fisher linear discriminant analysis, and the typical procedure of the same goes in this particular manner. And any new record or any new customer X that is coming up, I'll be assigning them to W1, omega 1 or omega 2, depending on whether I'll choose some kind of a cutoff point alpha here. So depending on whether W transpose times X plus alpha is greater than 0 or less than 0, I'll try to push that particular risk into good borrower or a bad borrower kind of scenario. So the alpha, there is no mathematical or anything, it's purely chosen by the user, right? Now this is where even the software tools are developed today to understand this process. I don't need to do this entire kind of maximization and all on a manual basis, right? When I refer to statistical packages like R or SPSS or SAS, these are all built in, which can help me in doing this process in a full-fledged manner. And here when I am doing a parametric understanding, right, just assume that S of X is a score function which is W transpose X plus alpha. Once I have chosen the alpha, the whole Fisher's rule is a clear-cut segregation for W1 and omega 1 and omega 2, because this is the formula that is going on for the classification of omega 1 and omega 2. But it is only doing the classification, it's not providing the probability of a particular person being belonging to group 0 or group 1 or default or non-default. Now this is where we talk about a slightly different model. If at all my intention is to come out with probability of default, try to come out with whatever, okay, W transpose X plus alpha, take that, right, that is Sx, take that value as the probability of belonging to group W2 given X, and based on that do a linear regression, and that can help me in terms of obtaining the probability that a particular risk or particular borrower can belong to a default class, and 1 minus of that will tell me the probability that he will belong to the other class. So you may try to, if it goes above 1 or much below 0, try to make some adjustments so that the whole data fits into the 0 to 1 kind of an interval, because a regular linear regression may have values much above 1 or much below 0 also. So some kind of an adjustment to the same needs to happen so that the whole value fits between 0 to 1. But just to understand as a process, linear discriminant analysis is a very good scoring model which can classify based on a set of variables whether a particular borrower falls under the good risk or a bad borrower kind of a category. Similarly, a small improvisation over that linear discriminant analysis itself comes out with Logit and Probit. If you look at it, the same S of X, which was the score, which we have used W transpose X plus alpha. Here, if I am able to write it as the probability of X given omega 1 divided by the probability of X given omega 2. Based on this, a slight working around mathematically, I can very well come out with the probability of omega 2 given X, which comes out with this kind of a formula. And here I can very well make an assumption that beta is a constant, which talks about the relative proportion of the firms in the two classes, because if I do this, all I am ending up with is 1 by 1 plus e to the power of W transpose X plus alpha plus log P of omega 1 divided by P of omega 2. This entire thing we have called it as beta, which we simply said as alpha plus log probability of W1 by probability of W2, which is coming out as a constant, which is talking about the relative proportion of the firm in the two classes. The only difference is the only difference which we are talking of here is the probabilities. We are following a logistic law, and that's the reason we are calling it as a Logit model. Otherwise, I can make it follow a normal distribution In that case, we call it as a normit or a probit kind of a model, which will have a thinner tail compared to the logit model. But when we are doing the estimation, either of the methods can very well be used. They don't make a big difference in the real world estimation, right? And the assignment to the classes, the default versus the non-default in any of the mechanisms, the process remains the same. I look at S of x, which is comparison with W transpose x plus alpha. If it is greater than 0, I'll assign it to a group W1, omega 1, or if it is less than 0, I'll assign it to the group omega 2. So that process will still remain the same as what you have done in the linear discriminant analysis, right? And estimation of the parameters is performed by the maximum likelihood approach. Now, all we are saying is we just need to be aware that we can use these kind of models for classification, because there are software tools and packages, statistical packages, which are available, which can perform this kind of a process for us. So just an awareness of the availability of these tools for this particular purpose. That is one place where we have to be comfortable with. The same way goes with a non-linear logic, especially if we are assuming that the variables are not linearly related, there could be a non-linear relation. Then we can do a slight more different transformation where I can, here if you see, instead of using W transpose x plus alpha, we are saying W transpose T of x plus alpha, right? And T of x, we are going with a non-linearity here, xi to the power lambda I minus 1 by lambda I, where we are talking about a convexity parameter for lambda I. So there could be 2, 1.5, 1.8, 2.5, whatever it is. It's a convexity parameter. And based on this, we are trying to arrive at different kinds of transformations, and that is what we are calling as Box-Cox function. Similarly, I can have a quadratic logic, wherein instead of just taking x, I'm also focusing on x1, x2 kind of logics. So we can have different kinds of mechanisms, but at the end of the day, either it's a logit or a probit kind of a model, but it need not be considering only the linear transformations. Non-linear quadratic can very well be used. But the advantage is the non-linear kind of stuff is we have more parameters now, which means there is a possibility of coming out with a much better fitment and a much more better predictive model compared to the typical linear models. Yeah, all these are present as a part of sophisticated statistical packages. So we really need to have an understanding of the usage of them so that we can run them comfortably on the statistical packages. Now we'll try to understand another set of techniques which can be helpful in assessing the default of a pattern, which are typically categorized as the unsupervised learning techniques. So the unsupervised learning techniques. So the two major techniques that come under that category are the cluster analysis and the principal component analysis. Sometimes people also call it as factor analysis. So the main objective of these two mechanisms is to reduce the variance. The kind of, so variance reduction is group homogeneous, bring out homogenization in among the data. That is what is variance reduction. Means group all the similar institutions together. So try to understand which institutions or which entities can be grouped together based on the kind of similarity of the features they carry, separated from the other group. So this is the kind of a mechanism which can be used for creating the homogeneous groups. That is what cluster analysis is meant for. Whereas principal component analysis is trying to reduce the correlation between the various variables. It is trying to remove the correlation between the various variables. So when we are talking about a data, cluster analysis is more about the various records or the various institutions and the kind of groupings that I can do to those institutions to make them homogeneous. So different kinds of borrowers are being aggregated. So it's a homogeneous grouping of borrowers based on their various parameters. So it's a statistical technique. There is a top-down segmentation of the borrowers that is typically being done. Now once the grouping is done, I can very well find out the empirical default rate for each of the groups separately. For group by group, I can calculate what is the empirical default rate, and based on that the default probability for each group can be found out. So here the way that is being used for grouping the borrowers is cluster analysis. The way to group the borrowers is typically done by cluster analysis. So it typically uses various distance based mechanisms to group. So whichever of them are very close by to each other in distance, they will be grouped together, and they should be farther away from the other groups. That's the kind of funda that would be applied in terms of cluster analysis. So it's a kind of exploration of the various characteristics of the borrowers. Whereas when we talk about the other set, which is the principal component analysis, or sometimes called as a factor analysis or canonical correlation, they all operate in columns. Means they try to find out the relationship between the various variables, or typically the column headings. Based on the columns, they try to transform the set of variables. So if I have 10 variables, they might group the variables and try to reduce them to 3 or 4 or 5 kind of variables which are more statistically significant. So they are doing a dimension reduction of the problem. So that's how these two mechanisms are helping us in terms of assessing the probabilities of the defaults and playing a role in the credit risk management quite effectively. So let's get a slightly more detailed understanding of the cluster analysis. So it measures the distance of the observations. It looks at the various characteristics which are associated with the different borrowers, tries to find the distance between them. So there is some kind of a criteria based on which the distance can be computed, and once the distance is computed, all those distances which are close by, they are treated as clusters, and each cluster should be very much away from the other cluster. So that's the kind of homogeneity that is preserved. So all these data which are together, that's one cluster. This is another cluster. This is another cluster. So within the cluster, they are all close by to each other, but they are away from the remaining clusters. So that's how the cluster analysis typically works. And once the clusters, so this is purely based on the distance. They have no meaning directly attached. The meaning has to be derived by the analyst only. So the usefulness of the clusters is purely based on the algorithm that I am using to define them. So this is one cluster, this is two clusters, this is the third cluster. Now what is the economic meaning of these clusters? Are they high price? This is moderate price? What is it? So we have to, whether this cluster will default more or this cluster will default more, or this cluster should have a good rating, this cluster should have a poor rating. There is nothing that is conveyed by the cluster analysis. So we have to look at the patterns on the identified clusters, and based on that we have to associate the economic meaning of each of the clusters. The way the cluster analysis is performed is based on either hierarchical or aggregative clustering. So there is a hierarchy of clusters that is typically prepared. This is how the clustering can go. This is a kind of hierarchical clustering, right? So there is a hierarchy of clusters that is created. Each cluster is aggregated. So this and this are aggregated to form this. Then this with this. So individually all of them are individual. Each one is a separate cluster. Now depending on the distance, if these two are the closest to each other, these two are clubbed to form one aggregation. Again, if these two are together, they are aggregated. Again, next, if this and this is together, they are aggregated. So this is how the clusters typically form, and this kind of a clustering tree is actually called as a dendrogram. So in an agglomerative kind of a hierarchical clustering, we are starting with the leaves. So we are starting where each one is a separate cluster. We are merging all the clusters together, and we merge it in such a way that overall we are going ahead with the final root, right? Until we reach the root, the merging is typically happening, and the merging is typically happening based on the pairwise distances. So the closest the distances are, they are first merged. The farthest the distances are, they are merged at the last. So the nearest cases are aggregated, and once they are aggregated, both of them are treated as one single unit. So this is the kind of a dendrogram that comes. Now if I want to divide the whole data into clusters, somewhere you draw a line. So at this height I am drawing a line. Now whichever are the number of points that are cutting it. So there is one cut here, there is another cut here. So this is one cluster, this is another cluster. So that is how we will define how many clusters are typically formed out of this cluster analysis. So I will get a few number of clusters where the size is too large if I am cutting it at the top. If I am cutting it at the bottom, I may get more number of clusters where the size of each cluster could be much lesser. But again, I should have a kind of a comprehensibility associated meaning to each of those clusters, so that I can really understand what is the kind of a differentiator between this cluster and the other one. That is the agglomerative kind of a clustering. But otherwise, I also have within the hierarchical, I have a partitioned, so we have a hierarchical or aggregative clustering, that's one. We also have partitioned or divisive clustering. This is also a method of the hierarchical itself. We are starting at the root, at the top. See, in an agglomerative clustering here, we started at the leaves, and after that we started merging. That is what is the agglomerative. But in a partition or divisive, we are starting at the root, and we are recursively splitting the clusters. So where we look at the center of, so initially we start off with some centers, and from there we try to push each one as a part of each of the clusters. So initially we create some cluster centers, which is what is the centroid, and after that we try to push each one into that particular cluster, and once it comes into this cluster, the center of this cluster is recomputed. Then again a new one will be checked which cluster it is closest to. So if this is closest to this cluster, it will be pushed into this cluster, and again the cluster center is recomputed. So the same way goes recursively until the last. And how many clusters I need to use, I have to decide explicitly. The system will not decide anything. I have to decide explicitly using some kind of a mechanism. So I may start with 3 or 4 or 5 clusters. So there are 5 random cluster centers that would be chosen, and based on that, iteratively the pushing of the elements to the different clusters is typically performed. So each observation is assigned to the cluster. As I was telling, each observation, should it go to this cluster or this, based on to which one it is closest to. And once it is assigned to this particular cluster, by including this observation as a part of this cluster, a new center value is created. So again, the next one will be verified against these different cluster centers. So whichever one it is the closest, it would be pushed to that particular group, and so on. Until the entire criteria is met, this process keeps repeating. So in this entire process, if you remember, if you see, there is a distance based measure. Everything pushing to a particular group is based on a distance. There are different ways in which the distances are measured, and the most common way is the Euclidean distance, where you are talking about the difference between, so it's a square root of the difference between the 2 points, 2 observations, the square difference between the 2 observations, sum of the squares of the difference between the observations and their resulting square root. That is what is the Euclidean distance measure. Very common one in majority of the algorithms. But otherwise, I can also use a Mahalanobis distance, where we are talking about the scales of the data, different scales of the data, and correlations between the variables are also considered while computing the distances. Similarly, we could also have a Hamming distance, different kinds of distance measures, right? Because that's the distance measure that is really distinguishing to which group a particular borrower needs to be classified into. So what we generally try to derive from this cluster analysis is, in real world we know that the many borrowers are outliers, and typically in a bank's credit portfolio, when you look at startups, companies which are almost on the verge of closure, liquidation, right, and companies which have just merged or demerged, they generally look completely different from the rest of the company. So they would be classified as a part of a different cluster, whereas all the normal companies, they would be classified into some other cluster. So that itself could be a kind of a base to differentiate those unusual kind of companies from the rest, right? So the disadvantage of this approach is it requires very high calculating power, but otherwise you can do the classification of the companies more and more comfortably using this approach. Then, moving on to the principal component analysis, as I have already highlighted, if we are talking of 10 variables, right? Now these 10 variables may have a lot of intercorrelation between them. They may not be independent in all aspects. They may be very much interdependent among themselves. So what the principal component analysis does is, it tries to remove or reduce the pairwise correlation between the variables by substituting, let's say, 3 or 4 or 5, a very small subset of variables as a proxy for these initial 10 variables, so that the total variability of these 10 variables is taken care of to a large extent, let's say 90-95%, by these 3 or 4 or 5 new variables itself. So that is the level in which the principal component analysis works. We are substituting q variables in a smaller number of m variables. So if there are 10 variables, I am substituting them with 3 or 4 variables, which are able to summarize the total variance of these 10 variables with this 3 or 4 variables itself. Again, this is computed through various recursive kind of procedures, right? We can look at various rotation procedures, We can talk about Varimax rotation, Promax rotation. Different kinds of rotation procedures are typically used to identify the principal component. So begins by extracting the first principal component where lot of commonality from all these 10 variables is being extracted, and all of them are taken as a part of one single component. Now after all the commonality is taken out, whatever are the residuals that are there which could not be accommodated as a part of the first component, between them or among them again all the commonalities will be extracted and formed as a second component. Now again the residual will be taken. Out of that residual again all the commonalities will be extracted into a third component, and so on. So at the max you can create q number of q number of components where q is equal to the number of variables in the original scenario. So when I am talking about principal component communality, because we are saying the one that is having the maximum communality will be chosen first, then the one that is having the next communality which is computed based on the residual after the first component is extracted, and so on. So this is basically talking about what proportion of the variance of the original 10 can be taken care by this one component. That is what is the measure of communality of that particular component. So the one that is having the highest communality means it's able to explain the variation of the original 10 variables quite comfortably to a large extent. So what we generally observe is the first few components itself that take care of explaining maximum variation of the original variables. That is what is the advantage of principal component analysis, which is drastically reducing the size of the data to a large extent. Now, so once we are aware of those two methods, the next thing I am trying to bring in is a cash flow simulation model. We are trying to simulate the cash flows using a Monte Carlo simulation model, and based on the way the cash flow is going below a certain limit when we are doing the simulation, the rating would be assigned accordingly and the default probability also will be assigned accordingly. So it's not a fully structured model which is directly giving me the probability of default. It's not also a full-fledged reduced form model where I have decided all the variables that are going to influence my default and then use a statistical procedure for it. It is somewhere in between. So we are looking at the financial statements of the company, and based on the assessment of what is the level of volatility that is there, we are doing some kind of a forecasting. We are trying to simulate the forecasted values of the cash flows of the company. So we are doing this simulation so many times and we are setting some kind of a default barrier. So we are simulating the cash flows of the company in various scenarios, and we are simply trying to see in how many cases the cash flow is going below a particular barrier. And depending on that proportion, we will be assigning the credit rating accordingly, and also we would compute the probability of default accordingly. So number of future scenarios where the default is occurring as a proportion of the total number of scenarios that I have created is a kind of a measure for computing the probability of default. So it's again very heavily subjected to model risk, because depending on what is the kind of distribution that I have assigned to the various financial parameters of the company or the financial statement elements will decide to what extent the cash flows are going to go below a particular threshold, right? So that's one of the prime reasons. There is a huge possibility of the model risk in this possibility. Now what is that default barrier. Again, to what extent I am comfortable in defining the default barrier is also a big question mark. I can't set it too early or even too late. So determining an apt default barrier is also very important. Along with that, the costs also need to be taken into consideration. So that's where the entire cash flow simulation model, though it might be a good model, there are some kind of a limitations that come out of it. Some of the important things: how much cash will be generated by the operations, how much of it will be used towards funding the financial obligations and investments, what determines how much of it would be cash flow from investments, how much of it would be cash flow from financing activities. So I need to have some kind of pro forma specifications for all the future cash flows, and based on that I should be able to simulate the model and then assign the probability matrix to those particular elements. So this is where there is a possibility of a lot of limitations coming up with the usage of this particular model. So to reach to the probability of default, either I can use a numerical simulation method or even a scenario based approach. So I am trying to find out the probability for all the predefined scenarios, and based on that what is the proportion or the weighted proportion of the scenarios in which the default have actually occurred, and based on that we are giving a credit rating. Or when I am doing a scenario, I am doing a lot of simulations, large number of iterations are being performed, and based on the relative frequency of going below a particular threshold, I can give different kinds of credit ratings to the different firms in this entire process. So that's how we are working out with the cash flow simulation model for both ratings as well as the default probability assignment. So now that we are done with the various quantitative based statistical techniques, if I look at the measurability and verifiability, Merton model very much verifiable, discriminant analysis very much verifiable, measurable, everything based on very solid practices. Unsupervised techniques, cluster analysis and all, I cannot measure it because they are based on the distances. So some level of ambiguity does exist with respect to measurability and verifiability, and the same goes with the cash flow simulations as well, because there is some amount of the model risk that is coming out in this process. Coming out to objectivity and homogeneity, it is very much possible in the Merton model, right? It's very objective. Some level of subjectivity exists in case of both discriminant analysis as well as logistic regression. There is a lot of objectivity, there is a lot of subjectivity in case of unsupervised techniques like cluster analysis and principal component analysis, whereas in cash flow simulations also there is some level of subjectivity. Coming to specificity, it is very high in case of both the reduced form techniques, but slightly lesser in case of the Merton based model. It's completely lagging in the case of unsupervised techniques. So if I look at it overall, the unsupervised techniques are much more weaker compared to all the three supervised techniques that I am seeing out here with respect to the aptness for being used for assessing the probability of default of a particular party, right? Now we'll move on to other approaches for modeling the default risk, wherein I am looking at heuristic approach, which is based on artificial intelligence techniques, expert system based mechanisms versus numerical approaches. So heuristic approaches, they are primarily used for mimicking the human decision making procedure. So various kinds of rules are typically being considered in a complex environment. Just like the way human beings make decisions, the heuristic approaches also make appropriate decision. and the new knowledge is purely generated on a trial and error basis, just like the way the human beings generate. So it's not based on statistical models. So mostly high frequency standardized decisions are reproduced at the best level of quality with the low cost processes. That's the typical way the heuristic approaches come into picture. One of the most efficient heuristic process that we are talking of here is the concept of neural networks. Whereas the numerical approaches, they are talking about optimal solutions based on trained algorithms which are making decisions in a highly complex environment. Actually, the artificial neural network come under this numeric approach, which are targeted, which are some kind of different complex rules, right, based on which the decisions are taken. So in expert systems, we have a knowledge base, we have working memory, inferential engine, and user interface. They are the major components. So if I have to talk about the knowledge base, so we are talking about the rules for decision making process. It's a long-term memory. The rules for decision making process, a long-term memory. So that is what we are calling as a knowledge base. So a decision making environment that emulates human problem solving approaches. That is what a knowledge base. So based on that knowledge base, the decisions are typically taken. There is a working memory, information on what problem needs to be solved, and there is an inferential engine which is more and like the heart and the nervous network of an expert system, which is actually having the ability to find solutions. So here we have different kinds of procedures in expert systems. One, a forward chaining, where you start with the data that is available and different kinds of rules are applied on that particular data in such a way that the final solution is typically reached. Whereas in a backward chaining process, you are actually starting with the final goal, come backward, get the path, see if and come up to the stage of the data to see if any of the paths are meeting the goals that need to be achieved. So if you look at the pictorial way here, I'm taking the different financial statements of the company and the various qualitative data of the company. So the quantitative, the numerical data, which is the financial statements, I'm also considering the qualitative data. And looking at the qualitative data, I can come out to an accounting behavior of that particular company, the kind of accounting practices that the company is typically might follow. So I'll club this financial statement figure and the accounting behavior of the company and try to perform an industry specific discriminant analysis. So within the industry, I'm going to segregate or I'm trying to form groups of companies, let's say based on clustering kind of a model. So I'm doing a discriminant analysis, I'm discriminating the firms within the industry. And once I have that industry specific discrimination, I'm having a set of rules for post processing. So this is an artificial intelligence based system, fuzzy logic based system, and based on that I am doing a proposed classification, and once the classification of the firms is done, I am assigning the credit ratings accordingly. That is how the expert system is coming into picture. Whereas in a neural network, we are trying to simulate the behavior of a human brain. So we have a set of outputs, we have a set of inputs, there are some kind of hidden layers. Hidden layers are taking care of computation of the relationships and the aggregation between the various inputs. Whereas the input layer is actually containing the pre-filtering information and the signals, and the various outputs are generated so that they will be playing a role in delivering the results. So there is a hierarchy of nodes here. input node, hidden nodes, output nodes. They are all determined by various mathematical models. All the relationships are explored through various mathematical relationships. Some kind of mathematical transformations are being performed on the variables. So, you can fit linear relationships, you can fit various non-linear relationships, everything. There's a lot of flexibility in terms of modeling the relationships so that the required outputs can, or the classifications can very well be driven. And the system can also improve the adaptability and learning from the successes and failures. There is a feedback loop that comes in. So based on the failures that are coming up, there is a feedback loop that is coming in. Means based on the various successes and failures, there is an internal learning process also that is there. So there could be thousands of nodes. So which means there are more than few thousands of the various connections. So the whole process is a very complex process, but it is very flexible. Right, I can put the linear relationship, I can put a non-linear relationship. All these kinds of things can be taken care of in a neural network. And even the feedback layer also can be very well brought into picture, which means there is a lot of connectivity between the nodes as well. So that's the kind of an advantage. And for learning process, there are hundreds of algorithms, or at least a few dozens of algorithms that can be used for learning purpose. Means different kinds of algorithms try to learn the successes and failures in different ways and try to assimilate the information in different ways, which means I can try all the possible approaches to see which one is really suiting to my requirement. But this entire thing needs to be treated as a black box. Means I cannot explain it to anyone. It's very difficult if I have to explain the process to anyone, because it's a very complex process, lots of loops that are built inside. So there is no way I can communicate the process to others. I may just use it for my classification purpose, but I would not be in a position to really dig through the whole logic and try to understand what has gone in the process. So no debugging can happen on this entire neural network process. I cannot do a step-by-step evaluation of how the results are cropping up. Now, how sensitive are the inputs? Garbage in, garbage out. It is very sensitive to the input quality. Right, more or less, if the input quality is not up to the mark, the output, the quality of the output also remains very much questioned. And another important part is, if I have qualitative variables, this model does not work. I should definitely have all my variables which are determining the categories. They should all be quantitative variables itself. So if I have qualitative variables or categorical variables which are influencing the default, then I may not be in a position to use neural networks at all. And another major limitation that we keep facing with the usage of neural networks is they are very highly subjected to the problem of overfitting. They learn too much from the data. So if I apply the same model back to the same data, they can understand and they can reproduce the data much better. But if the same model is tried and tested on a new data set, the accuracy of the model drops quite drastically. If that model that has been learned is tested back on the same data, the accuracy is very high. But if the same model is tested on a new data altogether, the accuracy falls quite drastically. That is what is the problem of overfitting. And neural networks are very notorious for the risk associated with overfitting in their cases. So once we understood the heuristic and the numerical approaches, again I can have a quick comparison in their cases. When I look at the measurability and the verifiability, it's much higher in neural networks compared to the expert systems. Similarly, objectivity and homogeneity wise, both of them are very objective. Both of them do a classification in a very streamlined manner. So the groups are very homogeneous. Specificity wise also, neural networks has a slight advantage over the heuristic, which means when I am comparing between the heuristic and the neural networks are a definite advantage over the heuristic. When I have to see, the place where I can use the expert systems is when the experience is very high for the expert, known, highly dominated experience exists for the expert. In that case, I can very well go ahead with the expert system, because the expert systems are very comfortable when we are talking about real life procedures, where the decision making is typically replicated with high frequency. The same process is being continued again and again. So there is a high frequency in which that particular process occurs, and I want more and more quality in the output. So they have the advantage of giving order, objectivity and discipline to the rating process. But they do not produce any new knowledge. So it's not a model. So they only derive some kind of pattern in the data and give an inference from the data, or they summarize the data, but they are not any kind of models. So they do not produce any new knowledge. Whereas in case of neural networks, there is a new knowledge that is typically provided. But remember, they are not statistical models. So because they are not statistical models, there is nothing associated with the probability of default. Now, once the classification is being done, based on the experience of what is the frequency of the observations in each rating class that have actually defaulted, we would be associating a probability of default to each of the rating classes. So, especially when your data is having a big quantity, where we are working with a large quantity of data, and the data keeps changing quite drastically, and the rules also have to change again and again based on the success and the failures. This is where neural networks come in more and more handy compared to the expert system mechanisms. So that's how we have to differentiate between the heuristic versus the numerical approaches for assessing the probabilities of default. And after looking at various numerical and statistical approaches to assess and compute the probability of default, obviously there is some kind of a requirement to look at the qualitative information also. It's just not always quantitative. There is a role that is played by the qualitative information in assessing the probability of default. So some of the things that are quick to look at: the sectors, competitive forces. We talk about the 5 forces, the Porter's model. So which are the various sectors that are, for that particular sector, what are the 5 competitive forces? How are the buyers' behavior? How is the buyers' behavior? What is the kind of sellers' behavior there? What is the competitors? What is the kind of entry barriers that are there? What is the kind of threat of substitutes that is there in that particular market? So we are looking at the 5 forces of the Porter's model for that particular industry. Then we are doing a SWOT analysis of the firm, the strengths, the weaknesses, the opportunities and threats. Management quality assessment is very much required. The stability of the entrepreneurs and owners is required. Reputation of the management staff. What are the kinds of succession plans that are there, especially when the managers resign, or the company is sold off, or someone are forced to move out of the company. What are the kinds of succession plans that are there in place? The continuity planning is there in place. Product quality, what are the kinds of various regulations that are there? They all play a role in assessing the probability of default. To what extent the consumers are protected? What are the risks for the consumers? What is the cost structure for the entire industry? What is the level of unionization that is there? Right? What are those financial risks which cannot be quantified? So you can look at various efficiency, effectiveness related issues. You look at right from administration, marketing, post-marketing, control, investment, technology, innovation. You can very well look at the qualitative dimension from all these aspects, which could again become different kinds of drivers for assessing the probability of default. And few more factors that you can look at for assessing the probability of default: the domestic market, right, the range of products or services that the firm has offered or is offering, entrepreneurial history, suppliers, customers, the quality of the suppliers, quality of the customers, the concentration is are they more diversified or there is only one single supplier? So we are trying to look at the monopoly versus oligopoly versus a perfect competitive market, commercial market, marketing organizations, kind of regions, countries in which the company is present, diversification, experience, quality of the management. So you could see there are so many qualitative factors that could be considered for assessing the probability of default. You can very well go through the list. You will very much appreciate that all these factors in some form or the other play a role in terms of assessing the probability of default of a particular firm. So when we are creating a questionnaire for credit analysis, obviously we take into consideration all these various qualitative aspects also apart from the various financial details of the firm. Corporate structure, talking about date of incorporation, since how long has it been existing in the business? Who are the group members? What is the level of relationship that is existing with the parent or the subsidiary? Companies business wise, the markets where the company is operating, at what stage in the business life cycle the company is currently operating, who are the competitors, what is the position of the company with respect to the competitors, what is the strength of the various competitors, what kind of competitive advantage the company has, is it a cost differentiator, does it have variety of products, is the company known for more and more quality, or is an innovative based company or technology dominant, right? All these kinds of competitive advantages would be very much assessed. The number of years the company has been operating in the actual core business also needs to be considered. The growth forecast, the quality of the various references, all these things form an important aspect in assessing the credit worthiness of the firm. Similarly, from the strategy perspective, I look at the strategy plans, the business plans, and various extraordinary transactions like revaluations performed, mergers, transfer of various business divisions, demergers, why they are done. All these things need to be present as a part of the qualitative items in the credit analysis questionnaire, which only in those cases will produce more and more thorough credit analysis of a particular company. Now, this is where I would like to end this session. We have discussed quite a lot of details regarding the various kinds of ways in which the probabilities of default can be assessed. We looked at right from rating agencies model of rating transition matrix, moving on to the expert based models, then various statistical based models like Merton model, logistic regression, linear discriminant analysis, cluster analysis, principal component analysis, cash flow based simulations, and also we looked at the usage of expert system models and and neural networks kind of models. And finally, after looking at the various quantitative aspects, we also got into the role of various qualitative practices also in assessing the probability of default as well as the credit worthiness. So if you have any more questions, you can very well get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.